Hello, folks. Welcome to another video by Rashi Alpha. In this video, I'm going to discuss the Q2FY26 results of a company which we identified identified 6 months back as a part of our bottom-up stock taking framework. If you're new to this channel, I will add the link to that playlist where you can learn how we do stock taking by that strategy. Okay, so I'm going to start this video as a part of a playlist of companies reporting good numbers in this quarter. Do some deep dive on the results and analyze the management commentary. So as you can see, one such company uh, which we are going to discuss is Tarachand Infra Logistics Solutions Limited. Yes, so recently we found that the promoters of this company have been buying some stake. Um, as you can see, they have increased their holding by around 1% in this FY26 financial year. So they bought in March, they bought in Feb. So this basically piqued our interest. We started studying this company and we started tracking it. So let me show what this company does if anyone is not aware. It's basically a company which offers two or three types of services. So one of them is basically warehousing and logistic transportations. So it provides warehousing and logistics capabilities for steel companies. Another, the most important one sector is segment is basically the construction equipment rental, where they basically buy these machinery like cranes, piling rigs, trailers, and they basically rent it out to EPC companies or those companies which are basically building such large structures. So let us see a bit about the results. So quarter on quarter results have been decent. I'll show you through a PPT which I have created. Uh, yes, just a second. So, as I was saying, there are three verticals. One is warehousing and logistics. So, in the steel warehousing, it has a good amount of experience. In equipment rentals and infrastructure works, it basically is a service provider for the infrastructure companies. This is the third segment, which I will not discuss much because the company has planned to ramp down this vertical. It's mostly a low margin business. It's mostly steel processing distribution provided to the steel companies to which it was providing the warehousing and logistics. So the company has decided to wind down this segment because it is not lucrative. Um, so as I was telling that the company has a lot of assets to its names, like these big machineries, cranes, trailers, and um, gantries. So they have around 392 machines. So how they maintain the asset is like they import these assets brand new from China and then they basically lease it out. Mostly the age is 6 to 7 years of their fleet, and they own these assets actually. They deploy these equipment to these sectors, rural and urban, metals and minerals, cement, and renewable energies. They have a good amount of utilization as well, 70 to 80%, and they have some operational strengths as the management says that they have a good turnaround, faster turnaround for the machinery. For the financials for the Q2, we can see that they had top line increased by around 11% quarter on quarter, and the EBITDA also increased by quarter on quarter by around I think, yeah, the EBITDA margin increased by uh, 28 to 60, so around 20 odd percent. I think their EBITDA, yes, EBITDA delivered robust growth 21% YOY, and their margin increased as well by 3%. The PAT also has increased, but not much, by 4%, but there are reasons why the PAT looks like a flattish growth. We'll discuss more. What is more important is that this cash PAT, because this company has been doing capex and has a lot of assets, there is a lot of depreciation going on, because of which affects the margins for the PAT. So if you remove the depreciation part, you find that there is a healthy cash PAT growth around 23% YOY, and the order book has been kept steady at around 128 crore. They had done in H1 of this year, they have executed I think yeah, around 128 crores, and they'll get more orders as we go on. They have mentioned that it's mostly like a 40-60 ratio kind of order book. So we are hoping that there will be more orders to be executed in H2. That order book distribution is more towards tilted towards 60% is tilted towards equipment hiring and project, which is good because this has more margins. We'll look at what margins each and every segment has, and warehousing has 40% of order book. Segment-wise, as I was saying, that the margin is the most in the equipment hiring and their specialized projects. Uh, they have around 60% of standalone EBITDA for rentals, and for warehousing, as you can see, their EBITDA margin is around lies between 18 to 20%. For the third segment, their margin is very low, so they're kind of ramping it down. As you can see, the top line from this segment is decreasing as well. One thing is that their gross yield is steady at 3.05%, and the finance cost is also stable. They have been doing constant capex for the last 2 years. They had done around 145 crore capex in last year, and they had maintained a target of around 100 crore capex this fiscal year. They have already achieved 83 crores, so most of the utilization will happen in Q3 and Q4. So I think better numbers are expected in the coming quarters. Their fleet size has been increasing. As you can see, since the fleet size is increasing, their gross block, so their net asset is net block, so the net asset is increasing as well. They have all recently added some high ton capacity of cranes, which will be used in some high margin business like renewable and power sectors. On the guidance side, the management say they have given achievable growth guidance of around 20 to 30% over the next 3 years, while sustaining strong margins. Now let's have a look at the top insights from the management commentary. Uh, these are some of the top questions which I picked out and the answers which the management provided. One was on the order book growth and distribution. So the management said that they expect 55 to 60% of total revenues in second half. So the order book will also grow in the same rate, with 60% from the equipment and 40% from warehousing. So the capex of 100 crore is good to go. They don't think that they are going to increase the capex for this year until and unless there is some exceptional order which comes up. So they believe that they had done around 35 crore of capex in quarter 1 of this year, and they did 50 crores around in this Q2. So they think that this will be good enough for the order book to be completed. PAT growth looked flattish, but yes, it was mostly because of depreciation, and there was one other income actually of around 4 crores, which was in the last fiscal year, which is not in this year. So and their net uh, interest which they had to pay on their debt increased a bit. So that is why the PAT growth looks flattish. Gross rental yield is around 3.1, which we saw. So the asset turnover is quite stable. Why the top line looked a bit flattish? Because the management said that they are ramping down on the low margin steel processing segment. So they are losing out on the orders from that part. And the rains this year was a bit extended. So that led to some slowdown in EPC projects. And they had to add some capex for equipment in the renewable segment actually for the equipment rentals. So that will basically bring back the growth in Q3 and Q4. One good thing which we saw that the cash flow from operations increased. So the working capital changes was positive, and their receivables are also in check. This is good considering the capex they are undertaking. So they are doing mostly more than 100 crore of capex every year. So they have to take in some debt, but their cash flow is increasing. So that means that they have the capability to execute the projects. Um, Receivables improved, yes. The key point why the receivables have improved is because they are shifting from the rural urban segment to cement mineral segment, and these newer segments have less debtor days. So the working capital cycle is good for these segments. Long-term debt has increased, obviously, because they have to fund the capex. So the debt to equity ratio is around 0.95, but that looks manageable by the company, because the management is confident that with the increasing cash flow they can execute more and more projects and can basically add to that can add to the cash reserves of the company. The key risk pointed out by the management is basically the government and private capex, which can go slow uh, for some unknown circumstances, but that will basically bring down the entire infrastructure industry down. So that's a very, I mean, not a specific risk for the company. It will be a basically a generic risk for the entire industry as well. So they also mentioned that some big companies have in-house uh, equipments. So they basically import it directly from China and use it. But the demand for these equipments is so much that they don't feel that it will be a threat to companies like Tarachand, which are basically leasing out these assets to so many companies. So as told you, yeah. So for the working capital changes, we see that they have around operating profit before working capital was around 42 crores, and so this is basically the net working capital changes, which is around 7.5 crores, and so the net cash generated is around I think 50 crores. Yeah, and the direct pay taxes after taxes, so the net cash flow is around 47 crores. So that is good enough to know that their receivables is also in check, which is not increasing much. Yeah. So valuation wise, if you look at the PE, it's around 25 price to earnings. But let's look more at the EV EBITDA side. It's around it's around 8. So EV EBITDA, so the median multiple is around 6.8. So it reached its max in July, and it was trading at around 14 times EV multiple. So I believe that once the company starts generating more cash, um, and starts having basically, yes. So already the current company is having positive cash flow from operations, but the free cash flow is negative because it's doing more capex. Once it starts capital utilizing the newly added capex, it will have start repaying its debt, and when the debt goes down, the net, I think the net the free cash flow will increase as well, and then the market will have much more will give much more premium to companies which are having so much free cash flow. And then so currently they start trading at 8.9 EV multiple, so it will have a lot of upside at that time. So that was a quick analysis of Tarachan infrastructure. Thank you.